Accumulation value is the amount of money earning interest. Surrender value only matters if you cancel. In this episode, I'm going to explain the difference and answer the question, what is the difference between accumulation value and surrender value on a life insurance policy? Hi, I'm Doug Andrew, and I've been helping people optimize their financial assets and minimize taxes for more than 46 years. One of my favorite vehicles to help people accumulate their money tax-free and then be able to access that money tax-free for 40, 50 years if they live that long, and then when they finally die, to have whatever they leave behind blossom in value and transfer income tax-free. I use what I call the laser fund. Now, a laser fund is a max funded indexed universal life insurance policy structured primarily for living benefits, tax-free income, but it also blossoms when you ultimately pass away and transfers income tax-free. So when people start looking at a max funded indexed universal life, they go, wait a minute, what's the difference here on my statements? It's usually the first 10 years, maybe 15 years, between the accumulation value column and the surrender value column. So let me tell you the difference and why it really doesn't matter unless you are thinking of canceling the contract. And if you're thinking that in the beginning, I would recommend don't take one out. So in a lot of my training YouTubes regarding max funded indexed universal life, I will use examples of somebody funding it with maybe $1,000 a month, maybe $10,000 a year, maybe $100,000 a year, maybe $500,000 a year. It doesn't matter what you begin with that really counts. It's what you end up with. So let's use a very simple example here of $500,000. If you're trying to comply with the tax citations TEFRA, DEFRA, and TAMRA, which I explain in other YouTube educational videos, then I cannot put in the entire $500,000 in one fell swoop. After June 21st, 1988, I have to comply with the TAMRA test. That stands for Technical and Miscellaneous Revenue Act. I can only put in about 20% a year during the first 5 years, and then I'm grandfathered to have tax-free income thereafter. So when I'm putting money into my indexed universal life, if my goal is to have the least amount of insurance the IRS will let me get away with and put in the most money as fast as they allow, then if it's $500,000, which we call the guideline single premium, the most I could put in would be 20% of that each year for the first 5 years, $100,000 per year. And so when you look at the illustration, you're only putting in $100,000 a year, but you're required to have the amount of insurance under TEFRA and DEFRA for the entire $500,000. So people look at the difference and they say, well, golly, I put in $100,000, my accumulation value is $100,000, and at the end of the first year with interest, maybe even more than that. But look, the surrender value is only $60,000 or $70,000. The surrender value only comes into play is if you cancel the contract. It doesn't come into play if you need to access money. If you put in $100,000, you went in and wanted to grab 20, 30, 40, 50,000, you can do that. That's not surrendering the policy. When you totally cancel an insurance policy, that's called surrendering the contract, and then the insurance company has to make up for the expenses incurred to establish it in the first place. Those expenses in the long run only drain out about 1% of the overall rate of return. If you earn 11, you're netting 10. Most asset managers charge 1% or more for your entire life on what the account grows to. With indexed universal life, you're only actually charged on the new money that goes in, not on the money that's growing. And so that's why many times in the long haul, with a $500,000 indexed universal life insurance policy, and when I say $500,000, that's not the death benefit, that's the money you put into it. You want that to double about every 7.5 years if possible. If you can earn rates of return of 9.6%, which is what I've averaged. I've actually averaged 9.62 over the long haul, but many years I've averaged more than 10, like the last 25 years, 10.07. I'm talking about since Universal Life started in 1980. And so it's not going to look real flashy during the early years because you're only funding it maybe 20% a year. After 5 years, now the surrender value comes up and it equals the accumulation value. But I would not set it up if you were going to be totally taking out 100% of your money in the early years. That's not what this is about. This is for long-term goals. Long-term meaning 5 years or longer down the road, like retirement. Most people make mistakes in America by using long-term investments for short-range goals, or the opposite. They use short-term investments like a bank or credit union for long-range goals, and they're only earning like 1%. No, you use long-term investments for long-range goals. So you choose investments based upon which ones are going to generate the most at the time in life you're going to be using the money the most, 10, 15, 20, 30 years down the road. It doesn't mean you can't access the money. If you can access in the first year, 20, 30, 40%, that's usually sufficient in the event of an emergency. But after 5 years, if you put in 500,000, the accumulation and surrender value are getting closer and closer together. By the 10th year, many times the surrender value equals the accumulation value. Some policies, it takes 15 years. But if you're concerned about making sure that the accumulation value is the same as the accumulation value, that there is no surrender charge if you were to cancel or access as much money as possible, you can design your policy to do that, but there's trade-offs. So what are the trade-offs? Let me explain first of all what the insurance company does. Every year they credit you interest based upon the general account portfolio if you choose the fixed option, the fixed universal life. But if you use indexed universal life and you link to an index in any given year, they are going to credit you the indexing rate based upon the index you chose, maybe the S&P 500, the Dow Jones, the Russell 2000, the Barclays US Dynamic Balance Index, or a combination of all of those. And this is where I have some years been credited 17, 25%, even higher with performance factors that we talk about in other educational videos. But see, they credit which number on your insurance policy. They credit that to the accumulation value. The accumulation value is the amount of money that the insurance company is crediting you interest on. So if you put in 100,000 and another 200, it is the higher number. That's what they're crediting you interest on, is that number or that balance. The surrender value only comes into play is if you did something stupid like surrendering and canceling the entire policy in the early years, and they have to do that because they had to establish it and incur those costs, just like in another video that I want you to watch. It's like a 5-story building. If the building is only 20% leased or 40% leased or 60% leased in the first few years, because that's what the IRS says, you have to wait 5 years to fill up your insurance policy, it's not going to perform very well until it's 100% full. The same is true as with an insurance policy. When it's maximum funded, pretty soon the surrender value comes very close and then equals the accumulation value. If you're concerned about making sure that you have access to 100% of the accumulation value, you can take out a waiver of surrender rider, or they're sometimes called different things, and you can do that. But there's trade-offs. What's the trade-off? By doing that, you have access to 100% of the accumulation value during the early years, but you're actually paying a little bit for that 100% liquidity, because down the road, if you're doing it for income, let's say it grows to $2 million or $3 million, and you want to pull out $300,000 a year, in other words, a 10% payout. If you chose to use the indexed universal life and have the surrender value be different the first early years, you will likely experience maybe an 8 to a 10% payout tax-free. But if you chose to have the waiver of surrender rider, The trade-off might be a 0.5% less in payout. Instead of getting a payout of on every million, 80,000 a year, maybe you're only going to be able to take out 75,000 a year. Well, I would rather have 80,000 a year. If your goal is to maximize your income and you want to have 8 to 10% payouts, then just go ahead and have the difference be there, because you can still access money. Most emergencies do not require people to take out 100% of what you put in the early years. Otherwise, maybe this is not the right vehicle for you. So make sure you analyze what your goals are, and once you understand that, realize you are earning all of your growth, all of your interest on the accumulation value. The surrender value really doesn't mean anything unless you were to totally cancel the contract during the early years. I'm one for the maximum income down the road, so I don't worry about the surrender value. I want the money credited at the highest possible rate as I can during the growth years, and I want the highest possible income down the road. That's why I don't worry about the surrender value or surrender charge, because I've never incurred it. So if this has intrigued you and you want to see some numbers, some charts, I would recommend my most recent book. It's book number 11, called The Laser Fund. It's 2 books in one. This one is 200 pages, comprised of 14 chapters with all kinds of charts and graphs. You'll see in here the accumulation value column next to the surrender value column, and when they equal each other, and how your money is growing based upon the accumulation value. If you want to learn how this works with stories, you can flip the book over. This is 100 pages, 12 chapters with 62 actual client stories. And so I'll tell you what, don't pay $20 for the book. I will gift you a copy of that for free. You simply go to laserfund.com, L-A-S-E-R fund.com, to claim your free copy. You contribute $5.95 towards the shipping and handling, and I will buy the book, and you contribute towards the shipping and handling. There's options in there if you like to listen and learn, watch and learn, for video and audio content also.